All right, this is Jeff Scott, and welcome to today's program. For those who have not joined me before, I've been giving some webinars for friends, for 3 or 4 years, monthly basis, sometimes more frequently, and I've had the opportunity to do some programs sponsored by HGSI.com. I enjoy doing them. I don't do them to sell you anything. I'm not hawking anything on this call. And I do this because it makes me, in a stepwise fashion, go through my review, and I get probably more out of it than anybody else does. And so I just decided, rather than repeat this as a webinar at night, to just go ahead and record it as I do my analysis. So again, welcome. Everybody has a disclaimer. I'm no different, and this is for educational purposes only. Anything I recommend is in the spirit of education. It should not be considered investment advice. I'm a doctor, not a broker. I'm not a professional investor. I'm not a professional paid investor for other folks. I invest a lot of my own money. But most importantly, you need to recognize that I'm a physician, not a broker, that most physicians lose money with their investments. And then something that I take great pride of, I'm not affiliated with any software vendor or trading company, and the tools demonstrate what I use. And I've not been paid to do any presentations, and I paid for all the tools that I'm going to demonstrate. Now, I have, and when I go to my desktop, you can laugh at how many programs I have. And I've had the opportunity over 20 years of playing in this marketplace to use almost every program on the market. I need certain things to be comfortable. I need a real-time trading platform, and I can use either TradeStation or Thinkorswim. I need something to do my analysis on a nightly basis, and I use High Growth Stock Investor. EdgeRater and ETF Bandit, to me, are instrumental programs that add to the value I get out of the High Growth Stock Investor, which I'll call HGSI. And then I do seasonal analysis, because even though I'm a big fan of top-down analysis, if something's gone up 7 out of the last 7 years over the next week, I probably don't want to short it. And then I'll mention a lot about Ian Woodward and Ron Brown. Much of what I go through is what I've learned from them, and I'll try to call that out when it happens, because I'm certainly not trying to suggest that I made all this up, but rather this is what I've learned from going to sessions with these folks and a lot of other smart people over the years. Couple comments. When I say add to my buy list, it doesn't mean I'm going to buy it at the open on Monday. I know that what the market does determines what my stocks do. And so I will take your 8,000 potential stocks and ETFs that I might be interested in trading based upon price and volume. I will get them down to a manageable list that I will be ready to pounce on Monday morning. And then if the market goes in the way that I'd like the market to go, and my stocks seem to be behaving, I might buy some of them. So all we're doing is identifying stocks that might seem appropriate. Now, we all have our own triggers, and on one of my upcoming Saturday calls, I'm going to invite Never Lost Trading, Thomas, to come and give a brief overview, because I've been implementing his tools, and although it's a whole new set of names, Thomas has really put together a nice vehicle that looks at where institutional money is flowing and actually prints within Thinkorswim buy sell signals and gives great information about where to place stops and when to use stocks versus options. So you really have to have a system to trigger and when to buy and when to sell. All I'm defining today is the market and what might be some attractive stocks. As usual, I will do a quick update, or not so quick update, on the market. I'll look at some of the tools I do for top-down investing, maybe some shortcuts, and intermittently I integrate other programs. And then when I do this live, which is not today, I will integrate audience questions. So during the week, if you want me to look at charts on a Sunday, and I plan on doing this weekly, I will be happy at my mdoc@mindspring.com. If you send me perhaps on Friday stock requests, I'd be happy to look at them. Once a month, I'll do this live, And when I do that, I'll do it on the platform using HGSI. George Roberts will sponsor that. At other times, I'm using my own software. Like I said, I'm not being paid to do this, so I can say what I want just based upon what I truly believe. I believe that if you've not been to one of the HGSI meetings, you're truly missing an opportunity to get exposed to a couple of masters. Ian Woodward on the left and Ron Brown on the right really are behind much of what I've learned. Great guys, and we have an upcoming meeting in October. My guess is there's not going to be very many more of these because Ian just had a pretty big birthday, and you know, just without knowing anything more than I know, I wouldn't miss one because one of these days he's going to decide that he's done standing up at the podium, which takes, if you come to this meeting, you'll see how hard he works. October 27th through 29th, Friday, Saturday, Sunday, Monday, it will be the best $1,250 you ever spend on your investment education. And again, I'm not paid to do this, but you'll see I'll spend much of my time within this program. It can be downloaded at www.highgrowthstock.com. Free weekly reports also from Ron Brown. He put one out this weekend. Talks a little about the upcoming meeting in PV and a little bit of where he thinks the market is. And then they give a free trial software download as well, including the data. So I always go to this slide, and to me the most important thing has been where are we at in the market. And I do top-down investing, although much of what I do is bottoms up where I look at stocks, but I think the most important question is where are we sitting? I thought we were up here, and I had started to believe that September is a tough month. We've had a nice run, and we were probably due for a sell-off or correction. But as we talked about last week and the week before that, very much a news-driven market, and that's exactly, whoops, don't like when I see that, and that's exactly what happened, and we saw the market actually break out from here and go up on news that came out Thursday and Friday. So I still think we're in a tenuous position, and let's go ahead and let's take a look at the market. Let me just close and restart my trade station just in case I need to go into it later on. 9.2 is a beta release, and this is my beta, which doesn't have all the data, and I've had some bugs in it, and it has a tendency to dump on me like it just did. But I'm using 9.1 on my other machine, so it's helpful for me to use. You know, if I'm going to use it on both machines, I have to have my beta version on the other. All right, so a couple weeks ago, I put up something called a Labor Day Leaders Index. And what I said was that this was a list of some of the best stocks in the market, leading stocks over the last several weeks, several months. And I created an index at HGSI of those leaders. And I mentioned at the time how this index had really not broken the green 17-day moving average in quite some time, and that, in fact, it was tracking above the purple 8-day exponential. Those haven't been here before. 8-day exponential, 17-day simple, 50-day simple, and 200-day simple. The ribbons we'll get to later. These blue painted lines here are pocket pivots, up, pocket pivots down, and I'll probably talk about kahunas, which is a momentum indicator that we use within HGSI. I am not going to go back and do basic education today, but if you, on the website, on YouTube, and on HGSI, there are multiple videos that I've done that are more for beginners, and on my YouTube site, the one that I did for Magenta last week would be a great place to start as I reviewed what each indicator does and what it means. When I put together my leaders index, it was not a buy list. In fact, it's underperformed since I put it together. But what it basically says is if the stocks have been leading for several months, If this market starts to rotate into other stocks, then this group of stocks, and hence the index, might falter first. And what we saw was, if we go back Friday, Thursday, Wednesday, Tuesday, Monday, a week ago Friday we had a bearish engulfing day on the leaders index. It pulled back to the 17-day moving average, which it had not broken since early August. And then it had a huge day on Thursday, gapped up on Friday, but really traded about where it had opened, creating a relatively long-legged doji with a pocket pivot. So this is a market that has not broken. And to me, a couple of closes below the 17-day. It closed below the 17-day with huge volume. A deep close on one day below the 17-day. That will tell me it's time to bail out of most of my long positions. And I am extremely long right now based upon what I trade. Now, I also like to look retrospectively at how the things that I trade have been behaving. And so one of the things that I do within HGSI, there's a tool called the Group Performance Analysis. And it's kind of like when you went to school, your GPA. And what the Group Performance Analysis allows you to take any list of stocks and measure its performance over a period of time. So those who were on last week, or who viewed last week's presentation, know that I created a series of lists that would have been on September 9th, and that's where I basically built some of my buy lists from, and we looked at some of these lists. So one question I might have is, with all these lists I put together, what was really working? So I can pull up all my different lists, and this gives me a great sense, frankly, of what the market is doing. So this assumed that I bought every stock on my list on Monday at the opening price. I closed it Friday on the closing price, and I bought $5,000 worth of each stock. That means if it was Google, I bought about 8 shares. If it was a $10 stock, I bought 50 shares. But from a percentage rise or decrease, it should be the same for each stock. And so what this then is a list of each of those indexes I created. It tells me the change week over week, winners versus losers, numerically and percentage. Now, I don't really look that hard at this list, but I like to scan down, and I notice 3 red things and a lot of black things. All right, so that means it was a very bullish week. I noticed that most of my bearish lists acted where they're supposed to, when they're in the bottom half of the list, or they're at the, or they're negative, which is off my volume. And then I look at specific things. I look at where is the S&P 500. You can see the S&P 500 had a great week, and it was up 1.94%. Now, what was moving is the next question, and I don't think this was necessarily an HGSI growth stock-led market, because if I look at certain things that I like to follow, the IBD 50 was only up 0.61, only 58% positive, and the HGS 150, which is a little broader based, was up considerably higher. Now, the problem with the in this case, it was about 120 stocks. It was up 2.65%. Since it's much larger than the IBD 50, it usually reflects to me a little bit broader reflection on the market, and the IBD 50 is kind of more tied to specific segment. The big cap 20, also an IBD list, was up 1.58, actually relatively underperforming. So what was performing? I go up to the top. Well, I mean, first thing I'd like to look at is my stocks is not my stocks, by the way. I wish that was my stocks. This is my stocks. So based upon the assumption of no money management, which is not true, based upon the assumption that what I had on Monday morning I had on Friday afternoon, not true, and then assuming that I don't have any protection in, also not true, my stocks were up 3.85%, and I was positive on about 68%. Now that's interesting. Then I like to look at the buy watch, and that's probably the one that I find most importantly, because these are the stocks that I identified as potential buys last weekend. I'm going to break these down in a second. And I can see that from the buy watch, I was 82% positive with nearly a 5% gain. So this makes me feel good because it tells me that the stocks, types of stocks that I like and the patterns that I like were outperforming the market. Doesn't mean I'm good or bad. It means that the stocks that I like were outperforming. Now, if I look at just a small group of stocks, these, except for the S&P 500, each of these are subcategories that I like to call from my buy list. So as we talked before, S&P 500 was up 1.94. My buy watch was up about 5% overall. 83% positive. That is, that's a home run week. It's not a typical week. And what's interesting, I like to look at what's working over the average of the buys. So pullbacks ready to run, those are stocks that I have pulled back to support, and then it either had a bullish candlestick, a kahuna, which is a momentum indicator, or a pocket pivot. They clearly were leading the charge. So I'm going to focus on those this week. Interestingly, and I think reflecting what we saw on Thursday and Friday, bottom fishing for nuggets also had a great week. Now, what kind of stocks were in bottom fishing for nuggets? I call these dogs because these are all stocks. Here's a educational services, here's a steel company that were pretty beat up over the past several weeks. And much of what this tells me is much of what we saw was junk off the bottom, responding to the changes from the Fed. I think the other thing that we saw was a shift from technology perhaps to material stock, oil, silver, coal. I talked about it last week, and I think it's really in force, and I'll look at some other data to support that. Breakouts worked very well last week, and you could see some of these stocks like GBX are very beaten up. But I also mentioned last week on my call that there were train companies, Greenbrier, Trinity, I think even LabTech is one of them, that were showing a lot of strength. When I get down here, as you can see, S&P 500 relatively underperformed. You can see the various stocks are listed in the different groups and how they did. So that tells me, so what have I learned? I've learned that, what a great week. I learned that I made some money. I learned that I proved false one of my laws, and one of my laws is that whenever I'm stupid enough to post on a board a list of stocks to buy, they usually all go down. And what I did last week is I posted this list. This is this week's updated list. And it was based upon those categories, and these all come from me looking at charts, and they're all very arbitrary. These are the stocks that I found. Now, I will probably post this again on the HGSI list if George wants to put it up. I have some really bad weeks sometimes, and sometimes even a blind squirrel can find the nuts. All right, so enough about the week that was. Let's start to look at the week of where we're going. So, as we've talked about many times, I'm into top-down investing. So I'm going to go into my warehouse view. I am going to now look at Woodward & Brown user groups. For those that are HGSI users, I have not put on the last add-ons that came out this morning. I'll be doing that later today, which for those that are not users, it's just clicking a couple buttons, but I didn't want to tie up my computer right now. So I'm looking at top-down analysis, gives me a balance, 1, 5, and a little bit longer, purely technical view of the market. It's all about price movement and volume, and it shows me that the strength remains in the NYSE. NYSE is a very broad-based index of thousands of stocks, big, small, and middle. Small caps clearly showing much strength. You can look at one-day performance and 5-day performance. What stands out as I look at this list? Commodities, no surprise with the market getting some QE3 plus on Thursday. The dollar continues to tank. We'll look at a couple of these very quickly. So you can see, and again, I guess I'll mention it right now. See my earlier videos for better explanation. These are some momentum indicators that I use to determine to be in or out of a stock. The bongos are an indicator that I created with a number of other folks that, especially if you're an ETF, I don't want to trade a lot person, that bongo green is a great time to be in an ETF, red to be out on the weekly basis. Kind of boring for me. I like to trade more frequently. Daily bongos, accumulation distribution, force index, which comes from Alexander Elder. On both the force and the bongo, the top one represents a longer term, the lower one a shorter term. And what I like to do is look for pullbacks, which means the longer term remains green and the shorter term returns red. Please don't overread the charts. All this is explained in prior webinars, and I will do a beginner's webinar from time to time so I don't bore the folks that come all the time. And we'll talk more about this thing called the high jump. This is a brilliant concoction of Ian Woodward. And you'll notice that whenever you get near the top of the high jump, the stock pulls back. Top of the high jump, stock pulls back, or in this case an indice. And we'll look at the high jump because you're going to see a lot of extended stocks. The high jump is one of these great things that Ian and Ron have brought to our community. Simple indicator, makes total sense. And to me, it's really the rubber band indicator. And we all know that if we take a rubber band and we pull it too far and let go, it snaps back. And when it gets to the very top, or to the very bottom perhaps, over time, it's the rubber band and it goes one way or the other. It usually returns back towards the mean. So the dollar's been in a free fall. It has a long-legged doji, not really great. On Friday, this shaded here is a bingo. Now a bingo is usually a sign of capitulation, and we might be getting to a point where the dollar is going to bounce. The dollar has been falling for quite some time, going back to late July. So even though QE3 came in Thursday on this candlestick, it's been assumed in the market for some time. Now you can imagine if the government says they're going to come out and buy bonds, that means there's a lot more demand, that they're going to, if they're going to buy mortgage-backed securities, then that might cause money to flow out of bonds and the price of bonds to drop. And you could see the bonds are dropping consistent with that. I don't trade bonds, and sometimes I have an issue with figuring out, I get it. Interest rates go up, bonds go down. But clearly, the Fed saying they're going to buy these MBSs has really caused further reduction in the strength of the bonds. But frankly, the bonds have been falling now for quite some time. Strength in the market, let's look at the NYSE. You'll see an opposite picture. And let's start to figure out where might this market go. So first thing is you look at the NYSE, and we call that a shooting star. Gap up. So this opened right where my candle point is. During the day, it traded up here, and then it closed right there. So it closed higher than it opened, so we have an open candle. But it has a pattern where it sold off after reaching highs. So if we look at it, let's see if I can shrink. It opened at 84.42, traded as high as 85.15, closed at 84.58. Volume was extremely high. Up 51.84 or 0.62%. So one of the things I mentioned last week is we might see the market go into a climax run and then sell off. So I guess I'm going to stay with that idea and wonder if what we're seeing here is not a rush to run up before we get at least a pause to refresh. And it looks to me like the rise in this market has taken off. So what does this tell me? Caution on Monday. Look to see what the futures are doing. And those that are uber long like I am going to have to start thinking about selling off some long, maybe buying some protection. Also recognizing that with the news-driven marketplace, no one says that this can't keep going up. Shooting star is a worrisome signal and suggests that we need to at least take a pause for refresh. And what do you see here? Right up at the top of the high jump. Forget, in the high jump, the absolute number doesn't mean anything. What's meaningful is relative, and you can see it's at the highest level it's been in quite some time. Now, let's look at a weekly chart on the NYSE. And I've switched to a different computer. It's still not a fast computer, but I think it's better than what I had last time. And one thing you might want to look at is kind of get an idea of where, I'm not great at this, but we are below the peak going back to April 11. So it's possible that we run up to a little bit above 8,700. What was the high in that week? High was 87.18. So I guess if you're really bullish, you might get a run up there. You don't have any overhead resistance. You've broken out pretty much, or you're at this level here intraday. Actually, I cheated. Intraday, you broke above that intraday amount, and you are above that close from that peak. So my next resistance is probably somewhere between 8650 and 8700, but this is not a market that is not without risk, but mostly because one of the nice things about HGSI, let's just do this real quick. If I go from the low here to the intraday high there, it tells me I've gone, in 14 trading days, I've gone up 17.9%. That's a good year in the NYSE. So pause to refresh time certainly is close to us. So we got a shooting star, we got a positive on the high jump. That tells me nervousness to be long short term, but when I take a step back and look at the weekly, I think we still got a little bit more to run. September is typically a bad month, so it would not shock me to see us have a pullback or at least a pause to refresh. Take a look at the NASDAQ. A little bit less worrisome candlestick pattern, and perhaps that goes along with the small stocks outperformance. And you can see here good volume if you compare it to the average volume. You had kahunas, which is a momentum indicator on this index or whatever instrument's being looked at. Eureka, which is a follow-through day for the NYSE, showing exuberance and strength in the market. Everything is green, gapped up from the close to the open on Friday. Closed in the upper half of the trading range. Still very bullish. Let's look at weekly on the NASDAQ. And, we've now broken out from those highs of last summer. And if we just bring in some more data, this NASDAQ is in really, you have to go back a long time. Now, obviously, you all know that there once was a time in 2000 when the NASDAQ was a lot higher, but that's kind of interesting. We perhaps, I hate to make more on this than it's worth, and it's probably impossible to draw an accurate trend line here. That wasn't accurate, so let's try again. We are right at the top, pretty much. You can draw things differently. Maybe I could have drawn it at this candle. But looking at from this high here and looking at the high before the most recent low, and draw a line, we're really at the cross of that. So, I mean, we're probably at a point now where it's time to pause and refresh on the NASDAQ as well. When I go back to the daily chart, you probably already saw it saying, but Jeff, what about your high jump? It's already up at the top. And it's not quite maxed out, so we may have room to go. If you don't believe me, just put up any chart, go into the views, go into HGSI strategies, Woodward and Brown, reference library, go, and then I think it's under Ian's high jump charts, and you can just duplicate this and look at chart after chart after chart. You hit the top, you're coming down. Now, you don't have to come down a lot. What I often see is a pullback to the 50-day and it goes again. Well, here's a case where it did it. So NASDAQ looks extremely strong and less worrisome for Monday than the NYSE. Gold has been on a tear. Of course, you know, I sort of poo-pooed it by saying very news-driven, and frankly, it is news-driven. But if we're going to inflate the economy with QE3, and my guess is that will force the ECB to go from austerity to stimulus because our dollar is going to get so weak that we won't be buying any of their goods. They'll have to stimulate, and that could really turn this economy around. Gold may continue to go up, but you know, obviously gold very news-driven. So my feeling on the market, Leaders Index has not broken. NYSE looks topping. The NASDAQ does not look as topping, but everything has had a very nice run. And let me go back to the NASDAQ for a second because that usually more closely reflects what I do and what my interests are. And if I look at the NASDAQ, and let's do that same measurement tool, and let's go from June 12th intraday bottom to the intraday high. Let's look at 2.5 months, 17%. You know, again, a good annual gain for the NASDAQ. Time for pausing to refreshing. One has to expect that this market is going to pause and at best go sideways. But I'm no guru. I don't know if it's tomorrow, if it's in 3 weeks, if there's more stimulus. There's so much news going on. One thing that showed a little bit of life, a little bit maybe being the critical word, is the VIX. So I remember when the market was in turmoil, and we talked a lot about, you know, the VIX had to get down below 20. I'm sorry about that. For us to get to a point. Beta versions, not always fun to install on your computer. VIX would have to get down to a point below 20 before we could feel like we were a little bit out of the woods from the bouncing around the market, the volatility. But, you know, look at where we're at today. And let's go back. This is 11. Let's bring in even more. I mean, yes, the VIX can drop further. But whenever we start to think things might be different this time, we find out that they're not. And typically a VIX this low, it's a sign of great complacency, but you know, sometimes from such low VIXs, you get powerful rallies in the market, or excuse me, powerful increases in volatility, rallies in the VIX, and drops in the market. You know, certainly no, quote, buy sign on the VIX. Everything is negative on the momentum. But you did have an up day on Friday, and it may turn out to be just a blip. But considering the QE3 and the exuberance in the market, seeing this volatility come back, ready for correction. I'll show you another clue, bringing in something from EdgeRater. This is a spreadsheet that in various forms we have been using at the within the HGSI community for years, and it was always, frankly, a pain in the butt to get Excel to cooperate, macros and issues, and the computer thought it was a virus. Chris with Edge Raiders put together a great program and incorporated this shot and the rest of the spreadsheets, but I'm just going to talk about that shot in the program so it's done automatically for me. So I'm a big Bollinger fan, but I'm actually a bigger Ian fan of what Ian's done with the Bollinger Bands, and I think this is important enough that I'm going to actually go basic. So Bollinger Bands are volatility bands around a price. You've got a moving day average, I believe it's a 50-day moving average in the middle, 53 or 50, I can't remember, and then a volatility-based upper and lower band. They contract during times of low volatility, they expand during high volatility, and like most standard deviations, they'll capture about 90% of the stock movement. That means 90% of the time the stock's going to be within the band. So if they get above or below the bands, odds are they're going to move back into the bands. You can figure out where you are for a stock or a market by knowing what your percent B is, with the top band being at 100 or 1.0, the lower band at 0. If you're above 1, you're above the band. If you're below 0, you're below the band. If you're at 0.5, you're in the middle. The movement within the bands in a given day may give you a clue to the power of a stock, and Ian and Ron have come up with the kahunas, which define large movements. I talked about their momentum indicators on my charts, and a big kahuna is a rare event and one that I like to stand up and take notice. If you divide this cup into 10 percentiles, let's say from 1 to 10, you would have 10 slices and know where a stock is between the top or the bottom based upon what slice. You add a slice if you're below and a slice above, you can divide the market then up into 12 slices. Now, in a bull market, you will bounce back and forth between the 50 and the 100 band as your stock goes up. In a bear market, typically you're bouncing below the lower band and the middle band. And in a very bullish market, you will start to get a lot of stocks above the upper band, but just like with the high jump bar, if you get too many up here, you're going to pull back. So we use the S&P 1500. I want to know how many stocks are above 50 versus less than 50. I know when it's above 70 or 80, it's bullish, very bullish. But I also know that if I get a big number up here, it's time to start thinking about booking some profits. But it can get a whole lot higher. So what do we see? 87% of the stocks are trading above the midline of the Bollinger Bands, which is a bullish finding. In addition, you can see very few stocks trading below the bottom, but perhaps contrarian worrisome is the fact that about 42% of the stocks are trading above the upper Bollinger Band. That tells me, in addition to everything else, that it's time for refreshment to come in. Not refreshment, I always like to drink, but it's time for this market to refresh. So I will then finish this section. This is where the whole story is. You got to know what the market's doing. But I'll finish this section by saying bullish long term, a little bit nervous short term. We're about to go, when we get through September, into a much more attractive time of year to be long. And September has had some great pullbacks over time, and I hope I'm not predicting that we're going to get one, but I think we're due for some sideways at best motion coming up. I just don't know when that's going to start, and as I've said before, markets have a tendency to go higher even though all the experts think they shouldn't. And as I wasn't the one that made it up, but I said on the board, things that are going higher, rather trade the market that you have, not the market that you think you should have. So now I'm going to look at industry groups and try and see where the strength of the market is, and it sort of will come out and hit you in the face. Now, I'm going to do something which we haven't done before, so I want to prove a point. I'm going to go into the ranking module. The ranking module is going to look at relative strength, and I can set that relative strength. I'm going to set it at E and slow. So this is going to be looking at an algorithm of change in relative strength compared to all the other stocks in the market. It's not a 1 week, it's a relatively slow indicator. It was probably, in my mind, it was first created to sort of mimic the industry groups, rotation, and a well-read publication. And it was a great way to time the market and to look for things that were going to become favorable. The way I look at this chart is I want it, green means strength. My God, look, if you don't own home builders, you need to go into another business, because home builders have been green, and I only got 6 months of here to save time, and in the top percentile going back for months. Now I could right-click on home builders, change the index group, and see what the strongest home builders have been. And this is the one that I own, but Pulte, KB Homes, Toll Brothers, these are just within the best of the best. These have been the top performing. And you probably recognize that some of these are great performing as well, but within the great performers, these are the ones that are doing well. If I want to look at percentage returns, let's just look at weekly percent change. And I didn't do that. Oh, I got it. I'm sorry. I have to go into raw relative strength. This 23% change in Hovanian over the last week, 21% in Beezer. As I said, I have Pulte underperformed at only 12%. So some of the leaders, Lennar, Toll Brothers, DR, behind the game. And if you look at, let me go back into actual relative strength, and let me look more in E and slow, you could see that some of these, the Lennars, the Meritages, the Horton, these got Beezers, these have been underperforming Pultes and Toll Brothers over time. So back to the main list, relative strength is a very powerful tool. So I'm looking for indices. Hold on a second. I'm looking for indexes that not only have been green for a long time, but rotation would mean, and that just for definition, green is the top 20%, yellow is the second 20%, red is the bottom 60%. So looking for transitions from red to yellow to green, red to yellow to green, or red to green, red to yellow to green, shows me rotation. And when I see green stuff going to yellow, or green going to yellow to red, that shows me rotation out of my stocks. So as I look up here, I see rotation into precious metals, rotation into oil, gas, and drilling, rotation into home furnishings, oil, gas equipment, healthcare, construction and engineering, gold, oil, gas, refining, and marketing. Boy, if you're not in refiners, you also have a problem. I don't know about household appliances. I mentioned railroads. So this is a great tool because as I see things going from red to green and making the top of my list, I know that there's group rotation going. So even though these are some of the things that worked really well this week, and let's look at raw relative strength, and let me change it to percent change 1 week up to the top. Even though you had great percentage gains, some of these have clearly been turning around. Aluminum, precious metals, some of these things have just had a great return, but had not just turned green, had turned green over the last several weeks. So there's been rotation in this market, and it got accelerated by QE3 that drove home building, metals, construction, oil, gas drilling, gas and equipment, etc. So very cool stuff in my mind that you could see rotation much earlier than perhaps you felt it in your pocketbook or in the indices. All right, back into the list. So if I look at a more balanced approach of what's been working now for the better part of 2 or 3 weeks, home builders, gold, mining, equipment, steel, exploration, refining, I want to know what's working right now. So we always go into my 2-day force up. Of the 140, 86 are positive. of the 140 or so, only 10 are negative. Airlines got clobbered, at least Allegiant got clobbered on, not Allegiant rather, Spirit rather got clobbered on Friday. And I've been interested in airlines. U.S. Airways looked good to me last week. And I probably would have to do some research into the fundamentals of what happened, but this guy tanked. Now you can right-click at any chart, go to Info from Web, pick your favorite. Let's look at FinViz. It'll open up FinViz website. We'll open up the exact stock I'm looking at. Oh, why shares dropped? I can even cut back guidance on revenue per available seat, a key metric. So that's bad for the whole industry. So that would probably explain. As I mentioned, U.S. Air I really liked last week. Now here's your pullback. Pocket pivots tells me it's ready to go. And we looked at it last week. It's a Friday, Thursday, Wednesday, Tuesday, Monday, Friday. So on Friday it looked like there was a pullback, had kahunas, pocket pivots, it was taking off. Now the reason why I like pullbacks is, you know, the right buy for me probably would have been this day because I would have picked up the kahuna end of day and I would have put my stop right here and I would try to trail my stop up here. So even if I was long, I probably would have gotten taken out before the big drop, but I probably would have lost money on the stock. But I do a lot of chart-based stops. When I use them, I do a lot of mental stops, and I look at the chart every night, and if the close violates my stop, then I'm out the next morning unless there's a gap up. So airlines are weak. Let's get out of airlines. So let's go back and look at where the strength was. Now the forced 2-day up is telling me volume and change in price, 2-day exponential moving average. It's really what happened the last 2 days. So as I've said before, financials are always at the top of one or the other list because of their volume. But if you look at 5-day performance of financials, up almost 7%, up over 1% on Friday. There's a reason they're at the top. Bank of America, I think there are a lot of comments on the HGSI board that the big winner of quantitative easing is Bank of America because we're buying their crafty bonds. And you could see what happened with a huge bullish engulfing pattern on huge volume on a Eureka day, clearly a buy signal on Thursday, nice run up on Friday. The best of the bunch, I've always said, is JP Morgan. And similar pattern, lots of pocket pivots, very strong chart, and we talked specifically about this on my call last week as a recommended stock to consider. I won't say recommended buy because all I'm asking you is put these on a list and apply whatever you like to determine if they're reasonable to buy or not. Oil glass exploration, a very strong move, up 5% for the week, changed index group. Well, sometimes you're just lucky. I think this is the one that I looked at last week, Pioneer, 1, 2, 3, 4, 5. And yeah, I liked this one last week because unlike most of these stocks that were deeply below the 200-day moving average, this one had just dropped above it, had kahunas, 1, 2, 3, 4. Now the advantage of doing this on a weekly basis is you can actually go back and look at some of the things that we talked about and why. I can't tell you the stocks are going up or down tomorrow. I can tell you what I think is important about a pattern and why it may go up. If the market goes up, they're probably going to go the direction that I think. If the market goes down, they're going to go the other, they may not because the market is so important. We had a positive market for the week, certainly favoring this sector, and this was a stock that was breaking out and continues to break out. This whole sector has negative earnings growth, but a lot of interest coming into the sector. I'm trying to think, the other one that we looked at in this group was, I can't remember the other one we looked at, but these have been really, this obviously is a very strong group. Now, I've been in this stock, and actually now I'm half in this stock. This is Whiting Petroleum, and there was a lot of talk about it being acquired last week. You can see it had a shooting star on Friday, so I'll probably, if the market is turning, this is one of the stocks that I'm either going to protect myself with some puts or get out of. I've got a lot of profits in it right now. But again, like the last one, frankly, like most of the stocks that are going to be up here, you're going to see a lot of stock. This is what we saw last week. Most were below the 200. A lot of them are regaining the 200-day moving average, EOG. These are big, big, big oil stocks. The whole index doing well. No surprise, it's the second-rated group. Semiconductors, I was wrong. I should be, and I admit it, I'm not a fan of First Solar. It was the top of the list last week, and I sort of was not very positive about it because of the solar business. It makes a lot of money. It's, if really makes this is the last 4 quarters, this is next quarter and the following quarter, if it truly makes this number, and this number is very suspect for all stocks because it's too far out, and it starts to have earnings share growth, maybe this is going to be a stock that recovers. You can see within the semiconductor group, a lot of group strength. Everything had turned green. I'm too worried about overhead supply, and I'm worried about this 200-day moving average. Overhead supply are all these people that have been holding the stock from back here that want to get out, and every time it gets a run, it's going to get smacked back as people try and get out from underneath a very big loser stock. Now, if it breaks above the 200-day moving average on volume, it probably comes back and retests, I'm all in because that's the pattern I like. I'm nervous about buying below the 200-day moving average, and I'm nervous about solar stocks. One that's been a leader has been Cirrus. It didn't have a great week as much of my other leaders, but it gave me the pattern I like. First of all, it's got great earnings per share growth, potentially the next 2 quarters. In fact, when I see a price-to-earnings ratio, which is high for a semi of 36, but a forward projected earnings per share growth of over 100%, that tells me that even if you keep the PE the same, the price is going to go up considerably because it's growing faster than the earnings rate, than the price-to-earnings multiple. Pulled back to the 17-day moving average, and then had a big up day on Friday on decent volume. I like this stock. It's in the leaders for that reason. It will, however, do what the market does. A lot of stocks that are sort of the Apple trade, which have been moving up late. Skyworks is one of them. I believe they're involved in components in the iPhone. Another stock that may be offering some interesting opportunity. Pulled back, didn't quite get down to the 50-day moving average. Kahuna, about average volume came in. This goes on a watch list, but I want to see what it does. And then I have specific signals that I use to get in. So what else besides technology? Back. Steel. Why did steel go up? We said it last Sunday. China said they're going to stimulate growth of infrastructure. Steel, coal, iron ore go up when you say that. Gold and copper go up when you say that. Where did I make most of my money this week? In Cliffs, in Freeport-McMoRan, and in Walters Energy, which was a coal stock that I go in and out of. So if you look at Cliffs Natural, it's sort of a combination iron ore and coal stock. It had a huge week last week, and it had a huge week this week. I said that I bought it because I followed the stock because I thought I had a pivot come in here, and I thought I'd get a run to my 50-day moving average. I was a little surprised that I got a run, and I broke through it. It, too, had a shooting star on Friday. Probably time for me to worry about protecting my position, maybe writing a call against it, and maybe selling it and booking my profits. Valley is a South American ore play. I don't know if they have coal, but they're a big supplier of the Chinese. Same exact pattern. First it's the market, and then it's the sector. They all look about the same. Steel play there. U.S. Steel had a lot of upgrades this week, and here it is, in the middle of our list. And you can see in U.S. Steel the same basic pattern. Certainly could trade up to the 200-day moving average, which is at 24.86. It closed on Friday at 22, so that's 250. So that's a 10% potential run there. These are beaten up sectors, and this is why I said there was a lot of junk off the bottom in this rally. Go back. Home builders, I'm not that smart. I was a little late to get in here, but how can you not love these stocks? They're all A on the accumulation distribution. They've been green on the weekly bongo for several months. Probably going into a climax run with a lot of the other stocks in the market. I'm going to be running out of time soon, so I'm going to go in and look at a couple of specific things and then cut this short because it's the start of the Jewish New Year tonight and I've got to get on the road and drive to family. Take a look at some of my buys very quickly, and then we'll look forward to seeing everybody next week on another one of these programs. So I'm going to rank these by, put these in scorecard, no index, which is what I like to look balanced, fundamental, and technical. And I'm going to look at some of these very quickly and comment on why I like them and why I'm concerned about them. And I'll look at 10 stocks and then I'll say goodnight. This is sort of my lightning round of things that I looked at over the weekend that I thought were attractive. Now, these are ranked numerically, not necessarily ranked by my favorites, and I'll pick out a couple after the first 10. Here is, in my weekend review, I saw a ton of energy stocks pop up. In fact, if I just take this list, oil, gas equipment, construction, apparel, retail, home building dominate. That's important because those are called wolf packs. Ron referred to them, refiners, today. These are the best charts, the best 52 charts I could find in the market, and they represent predominantly energy, construction, home building, and apparel. So what does that tell me? I know where I want to fish. If I'm going to go long, I'm fishing where the fish are fishing, or running. So let me go back into the pictures and just brief comments, because not everybody agrees with how I do things. You all do your own. All the momentum indicators are green, makes money, trades at a multiple of 28 while it's got a much higher growth rate, which I like to see. Sort of a cup, handle, breaking out, a pocket pivot, good volume on Friday. This is one of the stocks that I'm interested in. And my buddy Lou Powers, maybe he'll watch this and tell me why I do or don't like it. Lots of home builders, they all have the same pattern, certainly breaking out. Shooting star here. Here's the problem on the home builders, and you'll see this over and over again. They're maxed out on the high jump. These guys have got to go sideways and let the 50-day catch up. On assignment, interestingly, a temporary employment. I'd have to learn more about this. Is this a breakaway gap, a brand new gap out of been basing for quite some time? Huge gap up, giant volume, big kahunas. I'm interested in this stock. Maybe with easing, we'll see employment come in. Ease 22 grows at much above that rate. Something happened on Friday here. It's been sort of basing for some time. I'll take a look at a weekly chart. I'm interested in finding out more of what happened here, sort of a rounded bottom on the weekly. Is this thing taking off? I'm very interested. Something's going on when you see that kind of volume, a big gap up. And it certainly looks to me like a beginning of a move, not the end. Toll Brothers, guess what we're going to see? High jump at the top, big run. These are going to be interesting, the home builders, over the next couple of weeks because while Leonard not quite there, but also the middle of a big run. Refiners have done very well. Delec, and Western have both maybe given you some entry points as they base for a while down to their 17-day on this one. And Western refining, similar picture, pot pivots and a kahuna coming in. These guys will continue to lead, in my opinion. The whole group, Tesoro, Valero, Hollywood Frontier, great place to be in. These that have based for a while might be good times to look at them. A couple other things that I liked. iron. I think this is a China play. A zillion pocket pivots. Everything is green. Moving up off of its 200-day moving average. Again, I like to buy when they get above the 200 because I know I have support here, and I can put my stops a little bit below that support, and I'm not risking my family's fortune to do that. Was something. Here's one that was not one of my best buys of all time, but I've been holding on for a while. Halliburton, I guess perhaps it's getting over its challenges related to the horizon problem. Pullback, potentially running again, one of the leaders in the oil services industry. And I guess that's enough on the longs. You'll notice there's a lot less of the biotechs today. And I think that's rotation. We'll see, at least for short term. Priceline's another one that I'm intrigued by. You've got a squeeze here with all the moving averages coming together. You had a break above the 50 on Friday. The group is strong. Long-term bongo is still red. My cheating, not as long-term bongo, has turned green. I'm interested in Priceline. I'll probably play a vertical spread on that. I can only buy so many shares of $600 stock, so I will buy it in the money call. I will sell it out of the money call, and I'll keep the money between the two if it goes up and takes up the high at the cost of whatever my investment is. And with position sizing, I can, I know how much it's going to cost me, and I can control my upside. It's a low risk way to play this or Apple. On the short side, I got to tell you, I hate shorting stocks, and I'm not good at it, so anything I would show you, take with a grain of salt. If this market rolls, I'm probably shorting Intuitive Surgical. This is a monster stock. It's a stock that has historically just run, but it is beckoning to break down. If it breaks down below this blue 50-week, okay, which corresponds closely to its 200-day moving average. But if this market rolls, here's a stock that has a growth rate that's clearly slowing down, a PE that's much higher than its growth rate, 35 versus 14 versus 8. And if it breaks this line here, I know where to put my stop, it could fall a long ways. Now, I felt this way about other stocks, and sometimes I just get chicken and I don't pull the trigger because I'd rather buy contras and puts. But this might be an attractive play for buying puts or shorting. On that note, I'm going to abide by my family wishes and go get ready for the Jewish New Year and my drive. So for my Jewish friends on the call, L'Shana Tova, Happy New Year. For everybody else, thank you for participating. I'll post this on the YouTube channel, and I suspect it'll be posted on the HGSI site. I'll put my buy list, which will be a scary list because I think this is a tentative market at best, on the HGSI site. If you like the mumbo jumbo that I talk about on this call, not only check out the software, please consider coming to the Palos Verdes program, but there's a Yahoo board for highgrowstockinvestor.com. It is a great board. There'll be more concentration on markets and sectors and philosophy of the market than on individual stocks, but I can't say enough about it. So on that note, happy Sunday, good luck in your fantasy football.